I know it sounds like there's no hope, but as I told the CNBC Investing Club in our monthly meeting earlier today, I hope you joined it, we have to keep our eyes out for potential winners no matter what. I mean, look, consider the rails. They're soaring as a way to move commodities, especially coal, which has become red hot lately thanks to the global energy shortage. Consider any oil stock, any oil service stock, any utility stock, or the safety stocks we talked about just last night. They are working even as tech, led down by endless rumors of weakness, just roll over no matter what they say. I mean, look at the drug stocks, will you? So what does next week look like? I don't know. I think we got to go to our game plan because you'll see how treacherous this market can be. We're going to have to parse through the weekend's Ukrainian news on Monday because we now know it matters much more than pretty much anything that's here, including unemployment report, the big daddy of the most important report there is. The decline in stocks after that great employment report really was eye-opening. But on Monday, we have to consider what I think is one of the most exciting battlegrounds out there, and that's Kohl's. Yes, the department store chain with an analyst meeting. This is a pure financial clash. Activist investors claiming that management isn't doing enough to bring out shareholder value, and the company buying back stock hand over fist while doubling its quarterly dividend to 50 cents. Now, that's a pretty hefty amount. You could say, what do they have to do to make the activists happy? But you know what? I love unsatisfied activists. I think Kohl's is now a win-win situation for you because even if they don't tell a good story, the activist pressure will grow and management's much more likely to capitulate. Tuesday, we hear from there's a puzzling one, Dick's Sporting Goods. It's got a stock that's actually down nearly 5% for the year. I think it could be worth owning. This is a quality franchise with a terrific CEO and a business that I think should thrive post-COVID. I know the retailers have been up and down lately. Apparel was so bad today, oh my. To the point where many of these retailers have become too hard to call. But this one could be a buy both before and after the quarter. After the close, we have three kinds of hated stocks reporting. I think they'll tell us a lot about this tenor of the market. First, we have MongoDB. You know, that's one of the many database software companies out there that's growing fast, but losing a ton of money. Not too long ago, Wall Street used to love a company that grew fast and lost a ton of money. Now, they just feel total contempt for them. Next is Bumble. Now, that's an online dating platform with a stock that's down more than 75% from its initial highs. Maybe romance is dead? Then there's Stitch Fix, the online apparel play with a stock that's plunged from $75 less than a year ago to $11 today. Remember, apparel bad. All of these names live in the heart of the bear market we're experiencing. So Tuesday night will be a great test to see if any of them have fallen far enough to mark a bottom. Anything's possible. I recommend taking your cue from how these stocks actually behave. If it's even a little positive on uncertain earnings, then you may want to find some growth names in that sector with similar profiles that are making money and do survive.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.